Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm really pleased to have one of our more frequent guests, John Rubino, with me once again. He's, of course, the proprietor of the very popular website dollarcollapse.com. He's co-author of several books, a couple of them at least, with James Turk. Of course, Dollar Collapse is the one that has made him most famous, I suppose. Thanks for joining me again, John.
Hey, Jay. Good to talk to you again.
Always good to have you. Your ongoing understanding of what's happening in the capital markets. Your past on Wall Street, of course, is in the capital markets very valuable. So we want to talk today about what quantitative tightening, the ending of QT, might mean for gold. So I'd like to maybe look a little bit at the economy and of course. We saw an abrupt change by Chairman Powell just recently. Danielle DiMartino Booth, who was a guest on our show just recently, I know she was a big fan of Chairman Powell as he was entering the position of chairman of the Fed. She thought that he really would hang tough, that he would really allow the markets to go where they need to go for price discovery of capital. And he started out doing that, it seems, very well, very, very firmly. But then very abruptly, after the equity market started to cause a lot of people a lot of anxiety towards the end of last year, and very early this year, he did what some people refer to as the Powell pivot. So maybe you can talk a little bit about, is it justified? Was he justified, John, do you think, in suddenly reversing QT to, if not, I don't know if it's going to be quantitative easing, but at least taking QT off the table?
Well, the term justified might not apply too well to today's monetary policy because, there's really no rhyme or reason other than short-term survival to anything we've done since really the 1990s. But bringing it a little closer to the present, if you went back 6 months ago, all the world's major central banks were either tightening or preparing the markets for tightening. The Bank of Japan was talking about it. The ECB was talking about it. The Fed had actually begun to tighten. And then the global financial system spun out of control. In October, November, and December, we had an instant bear market. The price of pretty much everything crashed. And that terrified the central banks because they know how much bad debt there is out there. And they know that a sustained bear market in equities would throw the wealth effect into reverse. In other words, when your stocks are up, you feel smart and you spend more money. When your stocks are down, you feel stupid and you spend less. So that has a ratcheting effect on the economy. Stocks go down, the economy slows down. That makes stocks go down even further, and you run the risk of a death spiral in a highly leveraged system like this one that you can't get out of. They know that. So the volatility in the market towards the end of 2018 completely changed the attitude of the world's central banks. Where they were tightening before, now they're either neutral or they're loosening again. So we basically saw the tightening for this cycle. Of 150 basis points on the Fed funds rate, and that was it. And a little bit of a runoff from the Fed's balance sheet. But the other central banks didn't even get to tighten. They just got to talk about tightening before they had to reverse course. So now we've got basically global easing from the world's central banks of various types and at various rates of acceleration. But all of them are feeding more money into the system and either cutting interest rates or keeping them at like negative levels now. And then the Fed, the speculation with the Fed is, when are they going to do their first cut? Which is creating an interesting dynamic in the market because now bad news is good news. Yeah. Where, for instance, if we, 3 store chains, JCPenney, Payless, and Lifeway, announced that between them they're going to close 3,000 stores. Now, normally that's bad news for the economy, right? Yeah. But if it brings us closer to that first Fed interest rate cut, it's actually good news for the financial markets. So you saw stocks rocket on, German manufacturing is in recession and U.S. retail sales were down in the last report, and we got some bad factory numbers just lately. And all of that stuff is normally bad but currently good, because if it keeps up, the Fed's going to have to cut interest rates sooner rather than later. And that's what everybody's looking for. When can we start lowering rates again? They all want to know that, because that puts a lot more money into the hands of the big banks and financial speculators in general. And that levitates financial asset prices. So we're back there again.
Well, it seems to me, John, that what you're saying is the economy is the stock market. In other words, the stock market is the driver for the economy. It seems to me that it wasn't always that way. It seems to me, I recall a time when the real economy was the driver and the stock market was sort of followed the real economy. So if earnings went up, if the economy was strong, the investments would go into the equity market. Capital could be raised more efficiently for startups, for new or for expansion of existing businesses and so forth. But now it's almost as if the stock market is the end all, or if the stock market crashes, the whole system crashes. And instead of being based on the real economy, it's based on this sort of phantom economy, it seems.
Well, yeah, we used to have an industrial economy, which is an essentially healthy thing. And now we've evolved into a financialized economy, which is extremely unhealthy, because the product of financial institutions is debt. And you put them in charge, and it's like putting the car companies in charge of the economy. Well, we'd all own 3 or 4 cars, right, if the government made cars. But in this case, the government makes debt. If you assume that the big banks and the Fed and the Treasury Department are all part of one organization now, whose job is to grow. They do that by creating more credit in the system. And so, surprise, surprise, everybody's debt is soaring, and that's inherently unstable. You can only borrow so much money before your life collapses around you. Whether you're a person or a country, it all works the same way. And so we're deeply into that process right now.
Well, there have been an awful lot of people, and I can remember some college professors that didn't agree with what you just said. They said that the government can borrow endless amounts of money, and indeed, that seems to be what our government is doing, and a lot of other governments are doing. The idea that you can continue to print money, that you're a sovereign, and that you can always pay your debts back by printing more money. Why would that not be true going forward? I mean, why would that not be? It seems to have worked out quite well. We've had a major hiccup in 2008, I guess maybe more than a hiccup, but I think most people, John, that don't think about these things as seriously as some of us do, are just assuming that, it can leave it in the hands of these brilliant PhD economists at the Fed, and they're going to always save us. Why can't that go on forever?
Well, Jay, you said there used to be a lot of economists who would have said that's no problem. Actually, they're still around, and they're still running things.
Oh, yeah. Krugman and people like that.
Yeah. In Keynesian macroeconomics, which is the guiding philosophy of today's ruling class,
it's a philosophy, all right.
Yeah, it's a philosophy, or
it's not a science.
Oh no, it's nothing like a science. If it was a science, it would have been disproven by now by recent results. But what it also is a rationalization for people doing what they want to do anyhow. The big banks and the political class benefit hugely from a government that creates a huge amount of new credit and then creates a lot of new money to pay off the new credit, because they get that money first. So this is the best possible world for them, and they create rationalizations, which debt doesn't matter is the big one, to justify their behavior because they want to keep getting richer. But of course, common sense says that debt does matter. When you borrow money, you get to spend it, and that feels good, but then you eventually have to pay that money off. And that feels bad. And it messes up your life if you've borrowed too much money. And the fact that governments have a printing press gives them a little more leeway. That's the equivalent of a mailbox full of pre-approved credit card applications for a person, right? You can keep getting money that you don't have to do anything for, at least for a long time. But in the case of governments using an electronic printing press to create more currency, they're able, for instance, to control interest rates, at least in some cases. But what they can't control is the value of the currency that they're creating to pay off the debts that they're taking on. So only as long as the currency stays valuable can you play this game. But as soon as the value of the currency starts falling, then you lose the tools that you had to manage the system. And, go back through financial history, and there are dozens, if not hundreds, of examples of countries that did kind of what we're doing right now. They borrowed too much money, they created too much currency to cover their debts, and the value of their currency collapsed. That's called a hyperinflation. So Google hyperinflations in history. And you'll get this long list of, Croatia, 242,000% collapse in currency. And it goes on and on like that. Country after country after country. And on that list is the United States during the Revolutionary War and Germany in the 1920s. So it's not just banana republics. Big name countries have had hyperinflations in the past. And we're making all the same mistakes that those countries made. Only we're doing it on a much bigger scale, and we're doing it globally, because the past hyperinflations, you'll notice if you look at that list, happen to one country at a time in the context of a mostly sound money world. Well, now everybody's doing it. So the European Union and Japan and China and the United States are all heading off the same financial cliff at the same time. So what does that mean? That's the new element here. It's not that this time is different and we can get away with this forever. It's this time is different, and it's probably going to be a lot worse than what happened in the past.
A lot worse because all the countries and the economies seem to be sort of marching in the same direction at the same time. I mean, like everybody is hyperinflating in a sense.
Yeah. For instance, in Germany's hyperinflation in the 1920s, they had some special circumstances that led them to do what they did, and their currency collapsed. But everybody else in the world was on more or less a gold standard. And so the rest of the world had sound money, and Germany just imported some gold, backed its currency with that gold, and then went right back to having sound money a few years later. And how are we going to do that now with everybody collapsing at the same time? Well, it could be that we have to go back to gold again. We have to do a currency reset in which all the big countries devalue their currencies really aggressively against gold and then lock it in at some, $10,000 an ounce gold level, which means that the dollar henceforth is a name for 1/10,000th of an ounce of gold. And that would give us a sound money system going forward, but the governments of the world, at least today's governments, won't give up that kind of power, the power to make money out of thin air. That's paradise for a finance guy. I mean, ask any finance guy what he wants above anything else in the world. And, you might think he's going to say, love and understanding. He will say, I want to be able to create money out of thin air. Right. And all the finance guys running the big countries now have that power. So they won't give it up easily, which means we have to have a gigantic crisis to get us there.
Unfortunately, but if we just look at the dynamics, the mathematics, of course, John, with $22 trillion debt load now in the United States, a 1% interest increase. And I think you said that. How much did we raise? 1.5% or something like that.
Something like that, yeah.
Yeah. So $220 billion additional expense for our government with a $22 trillion debt load. And if we go into another dip, another major crisis, how much are they going to have to print this time to try to keep things from spiraling out of control?
Well, see,
and
that's why.
Will they be able to do it? Is the other question.
Yeah, well, see, that's why I can't go on forever, because each cycle requires an order of magnitude more debt.
Yeah, the math doesn't work.
Pull the system out. Yes, well, and then see, we're at the point now where we can never raise interest rates. We found that out. Interest rates have to stay extremely low forever to keep the system from blowing up. But that means you can't defend your currency when it starts to fall in value, because, we had a currency crisis in the 1970s in the U.S.
Yes, we
did.
And
what did we do to stop it? We raised interest rates to between 15 and 20%. Yeah. Can you imagine that?
I say frequently my first mortgage was a 17.5% interest mortgage rate in 1981. So, you can keep interest rates low, but that creates a lot of problems too. For example, the pension funds, and you had a great a bit of an article here that I thought was really, people should read at dollarcollapse.com, if you thought it couldn't get any worse for Chicago. And talk to us a little bit about it, because John, the pension funds used to be able to, to buy treasuries at reasonable rates and know with certainty that they can have the cash flow they need to meet the retirement requirements of their people in the pension funds. They can't do that anymore because there's no interest rates on those safe investments, so they're out there in the equity market. Another reason, I suppose, why the Fed has to keep the equity market from collapsing, right? But Chicago is one of those situations that's in big trouble. It's pension funds. New York City, I think, as well. I know our governor is starting to raise some alarm bells here in New York State, too. California, no doubt, has some issues. Talk to us a little bit about Chicago and maybe some other issues that might come up that really, it's not like lowering rates are going to fix everything. It's going to create new problems, right?
Yeah, well, Chicago is the epicenter of the pension crisis. But, Jay, we have to talk about gold. Will we have time if we spend some time in Chicago?
Yeah. So how does all this work out? So we're going to print money. We're going to debase the currency. So we need gold.
Well, the world that we're describing so far is paradise for precious metals, at least in theory. Because
in theory, we haven't seen it yet, John. It's not doing very much since 2011.
Yeah, not since 2011. But if you go back to 2000, gold was about $275 US an ounce. Mm-hmm. And so it's had a pretty good positive run as the currencies of the world have lost value. But it had a spike, a parabolic spike, heading into 2011, which was way overdone. So we're somewhere towards the end of that correction, just from a charting standpoint. Uh-huh. But the macro stuff, the fundamentals are amazing now, because you've got all the central banks easing, right? They're creating lots of new currency and either keeping interest rates very low or in the near future pushing them even lower, which means gold, which doesn't yield you anything, looks better and better against cash, which maybe yields you a negative return. And you've got all the governments of the world ramping up deficit spending, which turbocharges the monetary side of this. The more the governments borrow, the more central banks have to create currency to cover that debt. And you've got central banks buying gold where, until very recently, they were net sellers. So you've got all these fundamental factors that are drivers for higher precious metals prices. And now you've got Basel III, which is a new set of bank rules coming online, which treat gold as a higher quality asset than in previous rules. So it makes gold more attractive for banks to own, which is part of the reason for central bank buying in the past, but might also drive it in the future. So,
John, I believe that Basel III requires physical gold to be held by the banks, either on their own facility or at a central bank. That's my understanding of it. So that means physical gold as opposed to paper gold. The paper gold, of course, can be created out of thin air, and is. So that requires, as I understand it, is that your understanding?
I trust you about stuff like that, Jay. I'm hearing it from people I trust, and it sounds like that's true.
I did some digging into it, and I'm convinced that's the case. In fact, David McElvaney asked me if I could dig out. He was looking for information, and I finally found it. From the bank, the central banker's central bank. So that's what I believe, and I think that could make a big difference as well. Okay, so Basel III, and what are your thoughts about gold stocks right now, John?
Well, if gold goes up, gold stocks will go up by some multiple of whatever gold goes up, because they're just a lot more volatile. They're, the saying in the gold stock market is that the gold miners are leveraged plays on gold. So it's like buying a gold option or something like that. So the highest quality gold miners, which that's your forte there, so you've been finding a lot of exploration companies that are generating really extraordinary results. And those things will be like lottery tickets when people conclude that gold is going to continue to go up and silver will follow along with gold. Then you can buy gold, which people should do, but then people will start looking around and thinking, all right, how can I make real money in this market? Oh, yeah, that gold miner just went from $2 to $9 a share. I want to find the next one. And that's when things get really exciting. Yeah. And we're headed for that. If gold goes back up to its 2011 high,
Yeah.
which it ought to do in the not too distant future in this cycle with all the other stuff that's going on.
Yeah.
That would just turn the little gold miners into rockets. Some of them would be 10 baggers. In the time it takes gold to go up by 40%, a lot of these little stocks would go up 10 times. So that's the speculative but very interesting part of the financial system right now, I think.
Interesting and exciting. I mean, we just talked to John Anderson earlier in the show today with Triumph Gold. I know that's one that you're aware of. And that, there's option plays, and in fact, option plays on gold in the ground, and if it's not economic to get it out now, but at some higher price, well, it's worthless until you go through that higher price in which the economics start to work. Then all of a sudden, gold shares that are selling for virtually nothing become very, very valuable. Intrinsic value goes up dramatically. And that is one, however, that's the reason they bought that. They got involved in that story. But now they're making some discoveries that are starting to look extremely exciting. And that's just one of many that I follow. Many of them I know that I follow, you follow as well. Great Bear is another one, Noble Resources. There's a host of others. I think we're just about out of time. One closing thought, John?
Yeah, Jay, when you talk to those guys, tell them not to sell out too soon, okay? The people who have shares in Great Bear and Novo and Triumph, we want 1,000% returns. Okay, so don't let them sell out for double or triple.
Well, that's always a consideration and a question and a concern that I have for sure. So, John, it's so good to talk to you again. Thanks for coming on the show, and we'll look to have you back again sometime real soon, I hope.
Great, thanks, Jay.